Imagine a protocol that made $40 million in revenue last year, and Wall Street still has not priced it into the token. While everyone was watching Bitcoin and XRP, this DeFi protocol quietly became the backbone of on-chain fixed income. It processes nearly $48 billion in trading volume per year. It has $318 million of Michael Saylor's own company running through it right now, and the market cap? $259 million. That is a 6.5 times price-to-revenue multiple. For context, that is cheaper than most small-cap stocks on Wall Street. I am Tony, and today we are going deep on Pendle Finance, the bond market of crypto that nobody is talking about. Stay with me through this whole episode because the risk section is just as important as the bull case. We cover the good, the bad, and the ugly every time. And before we go any further, this is not financial advice. Everything I share today is for educational and informational purposes only. Always do your own research before investing in any asset. Crypto involves real risk, and you could lose money. Now let us get into it. Let's do a quick market check before we dive in. The good. The broader crypto market is up. Near Protocol jumped 13% today as investors bought the dip. Bitcoin is holding above key support levels. DeFi tokens across the board are showing strength. The bad. Bitcoin dominance is still sitting above 59%, which means the big money is still concentrated at the top. Altcoin rotation has been slow, and Pendle itself is still trading about 80% below its all-time high. The ugly. Over $630 million was stolen from blockchain applications in the past month. That is a reminder that risk is real in this space. We also saw the Pendle team deposit $1.27 million worth of Pendle to Binance back in February, which briefly spooked the market. And Arthur Hayes, one of the biggest names in crypto, sold 350,000 Pendle at a loss. We will talk about what that actually means in context. Okay, most people hear yield trading protocol and their eyes glaze over. Let me make this real simple. You know how Wall Street trades bonds? When you buy a bond, you are buying two things at once: the face value of the bond and the interest it pays over time. Pendle splits those two things apart so you can trade them separately. On-chain. Without a broker, without a bank, without a minimum investment. Here's how it works in plain terms. Principal tokens, or PT. You deposit a yield-bearing asset, like staked Ethereum, and Pendle gives you back a principal token. That token represents the core value of your deposit. You can buy it at a discount and hold it to maturity for a guaranteed fixed return. Think of it like a zero-coupon bond in DeFi. Yield tokens, or YT. The other token represents the right to all future yield generated by that asset. If you think yields are going to rise, you buy the yield token. If you want to sell your future yield up front and lock in cash today, you sell it. The AMM engine. Pendle runs its own custom automated market maker, built specifically for yield trading, not regular token swaps. It gives deep liquidity and accurate pricing even as maturity dates approach. And here is why this matters. Pendle captures over 50% of the total value locked in the entire DeFi fixed income sector. This is not a niche experiment. This is the infrastructure that serious money is starting to use. Let me show you the receipts. Pendle generated $40 million in annualized protocol revenue for 2025. That is real, on-chain cash flow, and not promises, not a roadmap. Actual revenue generated by the protocol, the average total value locked, what we call TVL, was $5.8 billion across the year, up 79% year over year. It hit a peak of $13.4 billion in September 2025. An annual trading volume hit $47.8 billion. Now, here is the wild part. That protocol, added with all of that real revenue and volume, has a market cap of only $259 million right now. That is a deeply undervalued ratio by any traditional finance standard. Now let's talk about the Pendle upgrade. This is the biggest tokenomics story of 2026. In January 2026, Pendle retired the old 2-year lock system, called vPendle, and replaced it with something called Spendle. Here is what that means for you as a token holder. Number 1. Liquid staking. You can now withdraw in 14 days or instantly if you pay a 5% fee. No more being locked up for 2 full years. Number 2. Up to 80% of all protocol revenue now goes directly toward buying back Pendle tokens for Spendle holders. That is real cash flow coming back to token holders. Not from new investors, but from protocol revenue. Number 3. Token emissions were cut by roughly 30% through algorithmic allocation. Less inflation, less sell pressure. All 3 of those things together are structurally bullish. But we will get to the risks in a minute, because this upgrade is not without its challenges. This is the part of the Pendle story that the market has not priced in yet. And I think this is where the real edge is. First, Grayscale. Pendle was added to Grayscale's official Q2 2026 watchlist. That is one of the largest digital asset managers in the world telling you they're paying attention. Second, Aave v3 integration. Pendle's principal tokens were approved as core collateral on Aave v3, with a $30 million supply cap. The governance vote passed at 100% yes. That means the DeFi protocol voted unanimously to trust Pendle's tokens as collateral. Third, a regulated product for European institutions. In March 2026, 3 firms, Everstake, Midas, and Apollo Crypto, launched a regulatory-compliant yield product built directly on Aave, Morpho, and Pendle. It targets 7 to 12% annual returns for institutional investors in the European Union. This is not DeFi for degens. This is DeFi for institutions with compliance departments. Fourth, Converge Chain. Pendle is a confirmed launch partner on Converge, the institutional blockchain that Athena and Securitize are building. It has native KYC and compliant on-ramps designed for institutional money. And now for the Saylor play, because this one surprised me when I found it. Michael Saylor's company Strategy, formerly known as MicroStrategy, has a preferred stock called STRC. It pays a fixed dividend of 11.5% per year. And right now, $318 million of STRC-linked total value locked is running through Pendle. Pendle takes that STRC dividend stream and tokenizes it, splitting it into principal and yield tokens. That unlocks fixed returns of up to 19% on-chain. Higher than STRC's base dividend, accessible globally without a brokerage account. When Michael Saylor himself tweets at Pendle's account about this, that is a signal worth paying attention to. Now here's where most channels would skip to the moon price, not us. This is where we earn your trust. Risk 1. TVL collapsed from its peak. Peak TVL was $13.4 billion in September 2025. Today, it sits around $1.5 billion. That is a massive compression. Most of that rotation happened because Athena's stablecoin yields, a major source of Pendle TVL, dropped. If yield conditions stay low, TVL may not recover quickly. And without TVL recovery, price recovery is harder. Risk 2. Token unlock pressure. The Pendle upgrade is structurally bullish, but it does not eliminate ongoing sell pressure from token unlocks. Venture capital wallets can and do sell. We saw this in February when the Pendle team deposited $1.27 million worth of tokens to Binance, which triggered a short-term sell-off. Risk 3, complexity barrier. Most retail investors do not understand yield tokenization. That limits how fast adoption can grow. Pendle is not a simple buy and hold coin. It requires you to understand what you are doing. And most people are not there yet. Risk 4, price is still recovering. Pendle crashed 67% from $3 in December 2025, briefly touching below $1 in April 2026. It has recovered since then, but it still needs to break key resistance levels on the chart before we can call it a full reversal. Risk 5, smart contract risk. This one never goes away. Pendle is audited, but risk exists across the protocol itself, the underlying assets it plugs into, and just plain user error. Never invest more than you can afford to lose. And one more thing I want to be straight with you about. Arthur Hayes bought Pendle heavily in late 2025, then moved some of his position to a brokerage in early 2026. Headlines called it a panic sell. In context, it looks more like a portfolio rebalance. But the fact that a smart whale took losses tells you this token has been punishing. Do not ignore that. After all of that, here is the bull case and why this week specifically is worth paying attention to. We are in a post-halving altcoin expansion phase. Bitcoin leads first, then Ethereum, then large-cap altcoins, then smaller infrastructure plays like Pendle. Capital rotation has not fully reached this category yet. That means you are potentially early. Point 1. Grayscale and Aave v3 are confirmed. This is not a rumor or a roadmap item. These integrations are live or governance approved. The institutional pipeline is real. Point 2. Pendle buybacks are deflationary. Up to 80% of revenue goes to buying back Pendle. That is real cash flow reducing the circulating supply over time. Unlike most DeFi governance tokens, this one has actual economics behind it. Point 3. The Saylor play is a brand new capital pipeline. $318 million of STRC-linked total value locked just flowed into Pendle. That number was essentially 6 months ago. This is new institutional capital entering the protocol right now. Point 4. Boros is going after the derivatives market. Pendle launched a second product called Boros for trading tokenized perpetual funding rate exposure. It hit $6.9 billion in open interest shortly after launch. At just 2% market penetration of the global perpetuals market, that alone could drive 15% more fee growth. The perpetuals market is worth trillions. Point 5. And fresh catalyst just dropped last week. On May 18, 2026, Pendle launched a new incentive program offering up to 200% APR in Pendle tokens for traders who place limit orders on yield tokens. That is a direct liquidity mining push designed to bring more capital into the protocol right now. At a 6.5 times price-to-revenue multiple with all of that institutional pipeline behind it, Pendle looks more like a sleeper infrastructure play than a speculative token. The question is whether the TVL comes back. And the early data in 2026 suggests it is. Before I let you go, I want to leave you with something I keep coming back to when I think about building wealth the right way. Proverbs 13:22. A good man leaves an inheritance to his children's children, but the sinner's wealth is laid up for the righteous. We are not here to gamble. We are here to build generational wealth through data, strategy, and freedom. Pendle may not be for everyone, but for those who understand it, it could be one of the most important infrastructure plays in DeFi right now. If you want to trade crypto or stocks, use Kraken. Link is in the description. If you want to invest in stocks, use SoFi. Open an active investing account with $25 or more and get $25 in free stock. Link in the description. Like this video if you learned something, subscribe and turn on notifications so you'd never miss a deep dive. And if you want me to cover another token like this, drop it in the comments right now. And as always, this has been for educational purposes only. This is not financial advice. Always do your own research. Never invest more than you can afford to lose. I am Tony. I'll see you on the next episode. God bless you.